Hello and welcome to episode 29. This week we reveal who won the battle between Greg's, JD Sport and Nvidia. We have our weekly portfolio update and we battle two more stocks against each other with this week's theme of index trackers. Without further delay, let's get underway. Every week we invest £25 into each portfolio. One portfolio where you select the stocks, one that tracks the market, and one that generates income to pay to you. We'll then invest an extra £1 into each portfolio for every 100 subscribers we get. Well, I have pie on my face this week because my suggestion of Greg's was outvoted. We're clearly not scared of a little chop. Deep seek who? This week's winner was Nvidia.
3, 2, 1, go.
I thought 2 weeks ago was bad. Last week was an absolute stinker. The benchmark and the battle royale down 3.8 and 3.6% respectively. That hurts. This week, fortunately, not quite as bad. I never thought I'd be excited to see -2 in the red, but there we are. Looking at the biggest movers in the battle royale, Spotify is trying its best to prop us up, going up 8% in the last week. However, Apple, Tesco and Expedia conspiring to keep us down with double-digit drops each. Nothing major in the important update side. Nickel's proposing a dividend. However, Black Rifle Coffee has had some terrible news. Consensus earnings per share estimates fall by 500%. More on that in a second. Here's the Battle Royale, and it doesn't make good reading. If you take a look at this column, the total returns, there's some in the green, but there's a lot more in the red, and it hurts my eyes. Our latest edition, Oxford Lane Capital, managed to fall 4.8% last week, and if you take a look at its stock chart, it waited right up until Monday and then dropped off the cliff just in time for us to own it. Good thing we're after that one for its dividends. There's a lot to talk about in the red down here, but I'll focus on our second worst performer, Black Rifle Coffee. As you can see, and as mentioned, it's fallen. The estimates for its earnings per share have fallen 500%, so we need to keep a close eye on that one. However, the stock chart hasn't completely fallen away. There is still a little bit of an uptick, so we'll keep an eye on forecasts and see what people are saying about that company before we decide to cut and run. It didn't look good, and it isn't. 27 holdings, 17 in the red and only 10 in the green. Once again, it's thank goodness for our dividend-paying portfolio. We're up to £21.06 in annual dividends. That's up from £19.03, or 30p rather, last year. We've received our December dividend payment of £2.43. Our next estimated one on the 2nd of April. The payment date is £4.31, so that's £6.74 being paid to a lucky subscriber. We've now invested £675 into each of our three portfolios. Last week it wasn't looking too healthy with the Battle Royale and the benchmark down. The income generator tried to keep its head just above water. This week, predictably, further in the red. The Battle Royale down a whopping 4.8%, and that's now costing us £29.53. The benchmark's costing us £14, but the income generator has made us, not including dividends, a whole £5.68. So not the best reading. Overall, we've invested £1,976, and it's cost us £40 to be invested.
3, 2, 1, fight.
Over the last few weeks, we've invested in companies that have had a big discount or companies that pay a big dividend to try and avoid some of that volatility, if we can call it that. It's not really volatile. The stock's only going one way and that's down. However, it is scary out there. But when you zoom out, you can see that over time, the entire market always goes up. And that's why this week we're looking at a whole index of companies, a whole bundle, and hopefully they will all go up over time. So the only question then is, which index should we look at? The best way to invest in the market is through an ETF market index tracker, and the best way to find out about ETFs is through this website called Just ETF. I use it for finding out anything about an ETF I'm looking into, and I think it's brilliant. Right, so which market indexes shall we track? Well, there is the classic, our benchmark, the All World, and I use the Vanguard FTSE All World tracking. The ticker is VWRP. It is, however, our benchmark, so whether or not we want to stick with that is a question. But that's one option, and and it's probably the safest. The other classic, the S&P 500, you can't really go wrong with that. VUAG on this particular tracker. When you look at our chart, it's fallen almost 10% in the last 3 months, so either a good discount or just the start of a massive crash. But as always, you go out all the way to the max and it's up 111%, so a very good and, in my opinion, relatively safe option as long as we invest it for the long term. Something more exciting, we could look at the emerging markets. Is this the best time to invest in them? Is there a discount? Not really, minus 1.5%. Overall time, it's up 84%, so not such a great performer either, so we can get rid of that one, in my opinion. India, some of the specific emerging markets that we could look at, but for similar reasons, I don't think it's performing that well over the long term, and it does have the risk. If that's a little bit too niche for you, or not niche enough rather, we can have a look at the Korean market, and for the same reason, I think probably we're not going to stick with this one. 15% over 5 years, not too much change over the last 3 months, but for my money, and I don't know enough about Korea either, so not for me. The last two are more interesting. The Nasdaq, there's an iShares Nasdaq tracker which does have my attention, and you can let me know what you think. Over the last 3 months, it's taken a 12% haircut, not great, and over the long run, 1,366, but that is a lot more risky, I will admit. Another slightly niche one I found was the S&P 500, but the IT sector stocks and shares on that in that market. It's over the last 3 months, it's down almost 14%, which is incredible. Again, long term, it's done pretty well. Do we think that that's going to be the case going into the long-term future many years? It's a very good question. For me, it's between the S&P 500 or the Nasdaq. It's slightly more specific, slightly more bespoke. I'm going to narrow it down to those two, and let me know what you think. So there you have it. What do you think? Which one do you think we should invest in? I've added each of them in the comments below, so just give a like next to the one you think we should invest in. From my perspective, I think it should be It's a new week, a new chance. Good luck to all of you out there. I hope it's not as bad as the previous couple of weeks. All the best. Thank you so much for watching.
Goodbye.